Sandip Sabharwal joins us now. Sandip, good morning. Thank you for joining us. It's just one of the phases of the market that everybody likes when correction comes, and before the correction, before they get a chance to buy, the markets recover.
Yes, I think there are two factors playing to it. One, the foreign investor selling seems to have suddenly died out, and although they're not buying in big numbers, but still they are small positive numbers. And domestic liquidity, as all of us know, continues to remain strong. Mutual fund figures for I think the last month are still to come out, but they should be healthy. So there are flows into mutual funds, PMS, AIFs, etc. But that keeps the market buoyant. On the other hand, we are also seeing huge supply these days. Like on a daily basis, now we see offer for sales, QIPs, etc. In fact, I think last many days, daily average would be more than 7-8 thousand crores. So that eventually will, I think, lead the market to give up some gains. Is my best guess. So September, October, in any case, tend to be months where after big up moves, some corrections tend to happen globally, also historically. So I think these 2 months we have to look out for.
Sandip, what about the other way around, which is that Fed has pivoted, crude is down, yields are manageable, and dollar index is down, which is that typically when these factors are at play, FIs they tend to buy. They tend to buy into emerging markets. If history is anything to go by and FIs they start buying, could we have a situation of no sellers now?
The only thing we are missing out, Nikunj, like I mentioned, was the huge supply which is coming into the market today. Can the Indian markets absorb a daily supply of 7-8 thousand crores of equity? I think that's the question. So I think typically, and the quality of the issues also is reducing. More loss-making companies are coming at high valuations. All of us know what's happening on the SME side of the market. So the primary market, I think, is more frothy than the secondary market, and that has historically been a concern. The points you raised about lower crude prices, dollar index coming off, etc., are valid concerns, which typically should be positive for emerging markets, especially the consumers of commodities. So most commodities have in fact corrected. So if you see steel, iron ore, all of them are at multi-year lows. Copper, aluminum, etc., which had run up earlier part of the year, have corrected more than 20% from the tops. So that's good for inflation dynamics overall. But the RBI continues to maintain a tight stance. And we recently started seeing some downgrade in GDP expectations also for India. So I think if the rates remain high, then some growth concerns could also come up. But overall, we are not in a bad state in the sense that we are looking at any kind of market meltdown, just a normal correction.
Going by the kind of move that we've seen in the last week, some interesting stocks, Piramal Pharma, for instance, Kaplan Point, these have been some of the stocks that have managed to gain. And you've also got a note that's, a lot of views coming in on the entire pharma basket. I'm curious to know where you stand, Sandeep, when it comes to pharma. Are you being selective here?
So right now, among the pharma stocks, the only stock we hold is Sun Pharma. We held Lupin from a very low level, which we exited because the stock ran up so much. So, but I think the news flow around the API, the entire API story, and whether API could, because of the restrictions on China, whether that becomes a big story or not, that we have to see. But it will be more long term, like it's a 3 to 5 year kind of horizon, because the approval process itself will be so long.
Is it time to hold, let's say, slightly higher than normal cash? 10-15% is the normal average which a lot of folks hold. But is it time to make that 25, maybe look at some tactical trades, or stick to 15, don't try to be cheeky?
I think 15 is okay because simply because of the fact that I'm not, my view is not for a market meltdown, but for a correction. So in that phase, and we have typically also seen that all stocks, all sectors don't follow the same cycle. So some companies might continue to do well even when the corrective phase is on, unless and until the market go into a deep sell-off. So I think that much is a good cash level, which gives you the opportunity to buy the stocks you want whenever the correction happens. And you are not with zero cash also at a time when valuations are actually high.
Just since we were talking about SBI and SBI cards, just wanted to know what your outlook is on both of these counters, because Goldman Sachs is talking about how there are multiple headwinds when it comes to SBI as the ROAs are peaking, and that the best of the credit costs now, that period is behind us. Would you concur, saying that yes, we could see some asset quality headwinds now building up?
Yeah, because that's a concern for the financial sector overall, the banks overall, because the asset quality obviously has peaked out in terms of like it cannot improve further from where it is. Now, the key is whether there is a significant deterioration or not, and I think that will determine how the banks will do. So NIMs are under pressure, and the benefit these banks were getting because NPAs were continuously coming down and write-offs were reducing, that will no longer be there from next year or maybe the second half of this year also. So the earning moderation will obviously be real. Uh, but I think on the particular on SBI cards and SBI, so I think there's a dichotomy because they are saying SBI cards, the asset quality concerns are peaking out, whereas they are growing for SBI. So both of those things do not match because cards is a unsecured business. So whenever the stress starts, it starts on the unsecured side first.
Group, it includes Saregama. It has First Source in it, I think. Couple of companies which, in a sense, Seat is part of the other group. I mean, the first company that comes when you say the Goenka group is Seat, but Seat is part of the other group. First Source definitely, Saregama certainly. Sandeep, Saregama is an interesting one, right? I mean, ultimately they have a monopoly. Now, whether it is retro music or the music library, they are the ones who actually have the rights. And given that it's now easy to hear, whether it is streaming, whether it is apps, whether it is music on the go, is this one of those businesses which you think you should just buy and keep? Why? Because that library, what they own, in a sense, it cannot be replicated.
Yeah, I've analyzed the company many times, but the concern the issue I always grappled with was what would be the growth prospects beyond a point of time. So, which I think is something which will be tough for them because the library can be perennially utilized, and they have done innovations in terms of coming out with their products with the music library and different kind of products, etc. Also, but then beyond a point, I cannot see growth because new additions will not be so much. So I think that's an issue I particularly grapple with. The stocks actually done reasonably well.
What is on your radar, Sandeep, which you would say that you would start buying on a 5% decline, you will add more on a 10% decline, and you double it up if it goes down by 20%?
I think post result seasons, like some companies which uh, seem to be on the turnaround path are companies like UPL. I think they went through a tough time. Now they have done some inventory corrections, etc. Crop outlook could be improving. So I think, and if a big concern for them has been refinancing of their global loans. So if the interest rate cycle globally moves down, that might not be such a big issue. So that's one company as a contrarian bet. We did pick up post results somewhat and would look to add if it corrects more. Then I think during the budget time, I had uh, said that a company which we own and which has also done reasonably well, SH Kelkar, which is on the flavors and fragrances side. So they've got a big order. The entire profitability cycle seems to be improving, and valuations are not so demanding. So I think these two. Uh, then among the companies we own, which has corrected because of poor results in the first quarter, but the outlook because of order book continues to be strong, is something like Aluwalia contracts. It's given up, I think, 15 odd percent from the top. If it corrects more, I think that could be something because the long term outlook is good.
Why do you like UPL? Because in the past, I know you've owned the stock even in different roles and different capacity. Some would argue and say that, look, they have multiple acquisitions, lot of debt, and forget that. I mean, they've not really been. I mean, this play on that, UPL will do well and agri will keep on growing. Some of that thesis has not added up historically. Do you think they will play around in future?
Yeah, it's not added on because I think they did the large acquisition, and then they took on a lot of debt, and then the cycle turned negative, and 2 years we had a very bad crop cycle globally. So those concerns are there. So we did own the stock for a long time now, but and I keep on tracking their quarterly results. So this was the first time then that one could see that possibly things could be bottoming out. So it's more a play on maybe we won't get into a secular upside, but then in such markets where valuations as it is are high, we are not looking at 100% gains from stocks. So I think companies which can give 20-30% also, those are very good companies in current market environment. So it's more a contrarian kind of bet, but then it will require the companies turnaround to keep on happening, and for that we'll need to keep on tracking it.
Sandeep, where is it that you've eased off or loaded off position, and have you exited private banks completely or not?
No, ICICI Bank we continue to hold. We have some Axis Bank also, where we exited was Tata Motors post last quarter results, because I thought that domestically things are slowing down, and globally also the outlook doesn't look to be so exciting. So I think that's one stock we sold off. We sold off many railway stocks because, in my view, the growth cycle was peaking out. So they'll still continue to go, but the valuations became very extended. So stocks like Titagarh, Taxmaco, etc., which we bought at very low levels, we exited. So with all of that, we've generated cash, and we are just waiting for newer opportunities.
You bought into Kotak, if I recollect. That time Kotak was going through two problems: transition issues and RBI diktat. And some would say that those issues still linger. There is no clarity from Reserve Bank of India as to where they want their digital payment business to move or digital app to move. And the transition continues. I mean, the management will take 2-3 quarters before they demonstrate that the new man means business.
Yeah, so it's a small allocation on a contrarian sort of strategy, where you buy when the bad news you think is peaking out, and then you wait and see when the stocks would perform, which could happen when the RBI restrictions are removed. On the asset quality growth side, there hasn't been much issue. I think it's once we saw earlier also with some other financial, like specifically, I think Bajaj Finance, when those restrictions got removed, the stock rallied. So I think it's more that kind of story. This is not a, I think, bank which will give us like this is not a stock which will give you very high returns, but it's more something where you buy when you think valuations have bottomed out and it could outperform.
Kunal? First one, metals have corrected, but there is weakness in the dollar index and there is cut in Fed, which means typically this could be a time when commodities could make a comeback. So play commodity for a bounce. The second trade staring in front of us is that commodities have corrected, so go for commodity producers, consumers rather than producers. What do you mind holds better chances the next 3 months, producers or consumers?
I would think consumers, because the only thing which matters for commodities in the current environment is what China is doing and how China is doing. And China continues to slow despite all measures by the government because of the kind of overinvestment they have done over the last 10 years or 15 years. So there are so many zombie projects, real estate, infrastructure, which are not generating any returns. So, and what most people don't realize is that even now, 50 to 60% of the consumption of most industrial commodities, steel, copper, aluminum, and many others, is because of China. So if there the growth is actually slowing down, then there's no case to make for a big commodity upside. So typically, historically, we've seen dollar index moving down has been positive for commodities. But if you look at the last few months, that's actually not played out.
So, Sandeep, largely, how is it that you're recommending, treating commodity sensitives and across the board, metal, crude, gold?
Gold is a different commodity because gold is more about economic uncertainties, about allocations, about people wanting to hold an asset other than which could be a hedge against maybe currency volatilities, etc. So I think gold is separate. I think gold will continue to do well, but rest of the commodities, I think we should be very cautious on most commodity stocks.
And what allocation does gold have in your portfolio, percentage-wise?
Could be around 12-13% today.
Okay. Okay, Sandeep, always good chatting with you. Thank you so much for taking the time out and speaking with us today. In the meantime,
If you like this video, then like, share and subscribe to ET Now.